So a very good evening to you all, guys. My name is Lapni Prem Chandani, and today we three are going to present you on this particular company, which is Rossario Biotech Ltd. So basically, this company it deals in the categories of personal care, performance, chemical sector, and also animal health and nutrition products. And also, this company is one of the leading specialty companies manufacturing in India. So it is having a good growth rate, it's having a good profit margins, and is going growing at a fast pace. Also, during this coronavirus, the company has not stopped its production because it can produce sanitizers, hand sanitizers, and all these things, which were useful and which led to a lot of sales and revenue generation for the company. Also, the company is spread across the 17 countries and offering a varied range of the product. And some of its major customers are Hindustan Unilever, Ghadi Detergents, CICO Technologies, etc. Also, coming to industry sector. So basically, this industry is all about chemical generation, chemical and textile industry, and this industry is growing at a pace of it's generating a market share of USD 237 billion, and also it is having a compounded annual growth rate of 5.4% in the near future. So the company has a lot of growth potentials. It is facing a little bit of crunch due to problems with blue sky policy. So basically, I will tell you what is blue sky policy. It is a policy for environmental protection which was being launched by China, and in this, they are trying to protect the environment. So, due to this and due to the slowdown which was in the trade war and the slowdown as due to the pandemic, all the sectors and all the industries were being affected. So, it was affected a little bit too. In 2017, an estimated 40% of the chemical manufacturing capacity in China was temporarily locked down. So, for that particular time, the company was not in working conditions and was facing a tough time and cash crunches. Bikash, can you please slide down a little bit? Okay. So from these graphs, you can clearly see that in the revenue contribution over years, the total TSC segment, which is total textile chemical production segment, it is in the wide range, and the revenue from this segment is boosting a lot. But in the recent times, what is happening is company is trying to reduce a little bit of benefit and trying to go and shift its benefit to home personal care segment. It is so hence this HPPC segment is expected to grow at 62.5% growth, which is a lot of growth. So this TSC segment, as it is in a mature market now, so this segment is going to turn up, and whole of the whole of concentration is being allotted to HPPC segment now. Uh, a little bit down. So these graphs basically tells about the revenues from different sectors in which this company is particularly doing its business. So there are three businesses like textile, chemical, animal health, and HPPC. So as I said, that it's a mature business of chemical. So it is having a normal growth rate which is 8.9%. Whereas the other two segment, which were understated earlier, are getting more attention, and hence personal care segment is being paid more attention, and is expected to grow with 95% approx. Over to you, Vikash.
Okay. We are now talking about the shareholding and the capex in the business. Prior to this IPO issue, the promoter shareholding with the company was around 95.06%, and the post issue it will come down to 72.69%, and the share shares with the public, which was around 4.94 percentage prior to the issue, will increase to 27.31 percentage, and it is in line with the SEBI guideline to reduce the promoter holding below 75 percentage. Now talking about the install capacity and the capex, they are increasing their install capacity at a very rapid phase, like from 60,000 million tons per annum in FI 2019 to 1,20,000 in FI 20, and they are setting up another plant in Dahej, Gujarat, which will be adding 1,32,000 million ton per annum capacity to the existing business, and with that they will be almost doubling their capacity by end of the financial year 2021. And looking at the capex, this is also increasing at a very rapid pace, which is also boosting the growth in the company. Like it was around 139 million in the financial year 2018, and it has increased to 760 million. It's almost around 5.5 times which what it was in the year 2018. Now talking about the QGLP analysis of the company, and starting with quality of business and management. Like I said, the promoters' interest in the company is very high, which stood at 72.69% as post the IPO issue. And they have also managed to maintain a very long-standing relationship with their customer, and that is almost more than 5 year. With the more than 5 year, with the 11 out of the 15 customers, which are major revenues contributor to the company. And RBL is one of the largest manufacturer of textile specialty chemical and acrylic polymers in India, according to the report by Frost and Sullivan in report in 2019. And they have very efficiently maintained the working capital cycle around 33 days compared to their industry average is 64.2. So this reflects the efficiency of the business and management. And along with that, they have also managed to generate profit over the years, like they have successfully maintained average EBITDA margin of around 14.3 to 5% and average return on equity of 28%. And the capacity utilization of their Silvassa plant, which has increased from 74.19% to 93.94%, which is one of their largest plant, and most of their production comes out of that plant for the company. Now talking about the growth in earning, like I said, the profitability of the company in terms of ROE and the EBITDA are increasing, and also the if you look at the revenue from the operation, it is growing at a CAGR of 32%, and the profitability or the PAT is growing at a CAGR of 66% over the last five year, which are very good numbers. And along with generating revenue, they are also successful in converting that into profit. And as explained earlier, the home and personal care segment is increasing the revenue contribution from the company is increasing at a very rapid pace. And so the recently, due to the COVID pandemic, the demand for products like sanitizer, disinfectants, and the hand washes have increased. This will add to the growth of the company. And talking about this SPPC segment, the home and personal care segment, that generally caters to the customer which are in the FMCG sector. And the demand in the FMCG sector is growing at a very rapid phase due to increasing population and the more and more urbanization in the country. So the demand is increasing in both in the domestic and also in the foreign market. And the company also entered into paid grooming and subcategory with the acquisition of Lojalo brand. And this will remain with the company, and also it will add to the growth in the company. Now talking about the longevity of quality and growth, uh, as I explained earlier, they are setting up another manufacturing facility at Dahej in Gujarat. which this the proposed installed capacity will be 1,32,500 million tons per annum, and they are also planning into entering into two new market, that is construction chemical market and water treatment formulation market. And the demand supply gap or the addressable market for this construction chemical is around USD 1.1 billion, and the water treatment formulation market is around 1.7 billion. So if they do enter into the market, they will experience high growth in the coming years. And they are very they are investing heavily in their R&D capabilities, and also they are focusing more and more on the eco-friendly and sustainable and innovative products. And they are also producing more and more customized product for their customer according to the demand from the customer. So this kind of and also the involvement of more and more technology, this will also stimulate the growth for the company for long period. And they are also they have recently entered into a joint venture with Buzil for manufacturing institutional cleaning and hygiene and disinfection products. Now talking about the price section, the IPO was valued at a PE of 33.8, multiple of 33.8, which was according to the upper price band of the price range. And if you talk about the PE of the industry, it was around 30. So if you compare it, this might be looked at a premium. The IPO was listed at a slightly more premium, but if you look at the business model of the company, the diversified product portfolio, and their strong profitability ratio, and their revenue and profitability growing increasingly growing over the year, that can justify the high premium paid by the investors. And the higher end of the price range of 423 and 425, the company was listed at a 99.99.9 times the EV by EBITDA, that is enterprise value divided by EBITDA. And the IPO price band was 423 to 425, and it was subscribed 79.37 times, but the retail subscription was around 7 times, but the non-institutional segment subscription was a very at a higher end. Now Santanu will continue.
Okay, so for story in graphs, as you can see, revenue, PAT, and EBITDA margin have been increasing rapidly year on year. And if you look at the inventory receivable and accounts payable, as Vikas has already mentioned, that operating cycle of working capital days for the company has been not only decreasing, but it is much lower than industry average. Financial summary, Vikas, can you scroll down? This is a financial summary for a financial year 20. Net revenue was 600 crore, EBITDA at 17.5%, PAT of 65 crore, return on equity 27%, slightly lower than FY19, and debt to equity of 0.2, up from 0 in FY19. But earnings per share increased from 8.8 to 12.6. Revenue has increased 62% over the last 3 years. Return on capital employed 34.5%, and average PAT margin in the last 4 years has been 8.625%, while the gross margin has been 33%. Scroll down. Here's a peer comparison. The peer comparison, the market cap here is 2207. This is based on the upper price band of the IPO. As you can see, sales growth in the last 5 years compared to its peers, Aarti Industries, Atul Limited, and Vinati Organics, the sales growth has been highest at 32%. The return on equity is also highest for Rossario Biotech Ltd. Scroll up. For risks and concerns. Now, a major risk for the company is the top 5 customers contribute 44% of the revenue. So, if loss of a customer could affect the business in a long term. The textile manufacturing industry is highly competitive, and Therefore, there is a huge competition in this. But 43.7% of the total revenue comes from this sector. Another major risk is environmental regulation. Since chemical industry is highly polluting, any changes in environmental regulation greatly affects business in this industry. Now, for conclusions and investment view, there are various chemical segments that it has not entered into, such as dyes, pigments, agrochemicals, flavors, and fragrances. And 47, which actually constitute 47% of the global chemical industry market. And only 12.2% of the revenue comes from export. So there is a large potential, untapped potential in foreign markets. Only 10% of sales are dependent on China, imported raw material, and less than 5% of which comes from China. That is, there is very minimal impact on supply chain. Increase in capacity, robust and experienced management, and sound corporate governance policy will drive growth going forward. This company also has diversified product portfolio and specialized need-based products. And looking at the strong financials and diversified product portfolio, long-term investment in this company is a good option.